Welcome to the Wall Street Lab podcast, where we interview top financial professionals and deconstruct their practices to give you an insider look into the world of finance.
Hello everyone and welcome to the first episode of the third season of the Wall Street Lab. After an extended summer break, we are back with top content for finance.
Yeah. Well, we I guess we apologize at the beginning of every season because the summer was way too nice here in Germany, and we were caught up in other projects. But we're back, and this time around we decided we would not release a trailer and just jump right into it. So we have a very interesting and special guest for the first episode. Andy, why don't you go ahead and introduce our first guest?
Yeah, I'm also excited to be back, and we're bringing someone really cool. We talk with Michael John Lytle from Tabula Investment. It's a fixed income ETF company. MJ has before been a founding partner of Source, also an ETF company. He has been before with Morgan Stanley and BlackRock as well. And we're going to talk about credit ETFs. We're going to talk about startups, how to build an asset management company from scratch. And this is a really exciting episode, so let's just jump right in.
Just one more thing before we jump into the interview. As always, if you guys appreciate the show and if it helped you in any way, please help us out with leaving a 5-star review on iTunes or wherever you get your podcast. This helps us to grow this show a lot. And if you would like to follow us more closely, you can go to our website, subscribe to our newsletter, as well as follow us on the traditional socials. So now, without further ado, let's just jump into the episode.
Hello, MJ. It's a pleasure to be here. Thanks for giving me shelter on this little rainy London morning. It's really cool to be here. For everybody that's listening, we are in an amazing office. Basically, I could throw a stone to Buckingham Palace. And with me is Michael John Lytle from Tabula Investments. Thank you for having me here.
My pleasure. Happy to give you shelter from the storm, whether it be the physical one outside or the one in the equity markets as we're currently experiencing.
You're jumping right into. Very cool. So before we start, I always ask, what is it that you do? If you have somebody outside finance asking you, you're at a dinner party, what do you do? How do you explain somebody that has never heard of finance before?
So that's the killer question, because if you're at a dinner party, let's assume that the person beside you is not another boring person from the finance world, and you need to explain to them what you do. It's the first question you kind of have to ask them is to contextualize what do they understand of the financial world. So just to preface this, my name is Michael John Lytle. I'm CEO of Tabula Investment Management. Tabula is an asset manager focused on passive fixed income, which in our case is mainly wrapping things as ETFs, because that's kind of been the vehicle for delivering passive fixed income exposure or passive exposure more generally. When people ask me what I do, I say, look, I basically recognize the sorts of investment exposure that people and mainly institutions want, and then I figure out the best ways to wrap and distribute those. So over the course of the last 30 years, I worked for Morgan Stanley for 18 years. I set up a new asset manager in 2008, 2009 called Source that was an ETF issuer that's now owned by Invesco. That was sold to Invesco last year in 2017. And now I've set up this company called Tabula. And each step along the way, my thought process has been, you need to recognize where value is, the kinds of exposure that people need, what's the best way to wrap and package that, and then to get it to them. Because frankly, the financial services space seems really complicated because there's a lot of information, but intellectually it's not that complicated.
All right. Wow. I think many people would disagree with the intellectual part. Why is there so many people at Oxford and Cambridge that try to study their asses off to be in finance if it's not that complicated?
Well, I think it's because twofold. One is if you take an intelligent person and you give them a task, they will make it more difficult rather than easier because it makes it more intellectually interesting. But the reality is most of what we do is actually on a basic level relatively simple. And your challenge as a business person is either to boil it down to its key elements and then tackle those, or you can start to cover it with more and more complexity. The problem with covering it with complexity is you just lose the vast majority of people from understanding or potentially being able to buy your products. Now, just to be clear, I'm not talking about selling products to retail. That's a whole other kettle of fish. I've always sold products to institutional investors, but even in the institutional space, you have a very broad range of skill sets and understandings. And it's quite easy, even if you're talking to someone who's a financial professional, to end up in a space that they don't understand. So given that I know what it's like to talk to somebody who's talking about their space, and I've spent 30 years all over the sell side and the buy side, and they can still talk about something I have no idea what they do, my challenge to them is to simplify it to the point where I can understand it. Not because I'm stupid, but just simply because there are lots of things one doesn't know. So if we go back to the Oxford and Cambridge question, that's really about the amount of information. So in a space like this, and in the new world that we live in, where data is not a problem and we're collecting everything, as human beings, we have this tendency to think that we need to now be able to process everything. And that's not what the human brain is for. We can use computers to process everything. We need to use the human brain to make sense of it. That's the thing we can do generally that computers have failed to do over time. So if you spend your time at school trying to turn yourself into a computer, you're fundamentally failing.
That's a great start for all our young students out there. Like, don't try to get yourself into be a computer. You're gonna fail anyway.
Well, I mean, and I think the other thing to remember is that failure is part of the process.
Yeah.
Right. Everybody says this, but it's the mantra. I spend some time out in Silicon Valley, and I have a bunch of friends that work out there, and they all say, you haven't really started until you've failed 5 times. Right. And I think in London, my experience is everybody thinks you cannot fail. And if you work for a large investment bank or a large asset manager, the consequences of failure are large. Because there's this general idea that you should be smart enough that you don't fail. On the flip side, everyone in finance says they want to emulate what's going on in the technology space, and they want people taking risks, and they want them to be creative. And then they say, well, you can do all that, but don't fail. And these two things do not work together. In order to take the risks that lead to great successes, you also have to take the chance that you're doing something that's not going to work. So the first thing I say to everyone young, and to preface this for anyone who can't tell from this interview, I have 2 20-year-olds and a 14-year-old. My 20-year-olds are at university in the States. One of them is doing engineering focused on IT, and the other one is doing psychology mixed with music and art. So they've taken slightly different paths.
Slightly, yes.
And I interview for my old university that I went to in the States, and and I also was part of their alumni network. And so a lot of people contact me through the alumni network. Sometimes they preface it by saying, I really love your insights. What they're really saying is, can I interview for a job? But what I say to any young person is you have to follow your dreams and your passions. You have to do something you really care about. If you're doing something and you're ticking the boxes, it will show through in one form or another. The key to good mental health is to be excited, interested, and doing something that you feel like you can make a difference in. If you're doing something that you don't feel like you fully understand or you don't really care about, eventually that will come through.
Yeah.
So, don't follow a path because you feel like it's the thing you're supposed to do. Follow a path because it's the thing you want to do.
And you can't fool anybody, right? If I'll interview for a job with you and I'll just clear my path like I think you would like it, you're smart enough to see right through me. You have the experience. And if you don't, you might not be the person I want to work for.
Well, what's the famous phrase? You can fool some of the people some of the time, but not all of the people. I think, although in today's political world, I'm not sure, maybe we can fool all the people some of the time. But no, I think you don't want to fool yourself.
Yeah.
That's the most important thing. And I talked to people about interviewing for university, and I highlight to them that, you can be a top student and have gotten the best grades that are possible. And if you sit down and interview with another human being and they're bored, that's not going to work out very well. And generally, if you're bored, they're going to be bored. And if you answer their questions as though you're filling out a question, a multiple choice question, or you're answering an academic essay, where creative spark is not the point, and it's all about ticking the boxes, and you have an essay plan, and you have to get through these topics, and you feel like it's a formulaic application of your intellect, it's just not going to work out. And the difference between academia, the early academia, so a primary and secondary school, and the rest of your life is that there's a lot of stuff you have to do early in life to learn some basic skills. And I have a friend who's a headmaster at a school, and we often have the debate about how do you excite students, and how do you make them better, and how do you prepare them for life. And there's a lot that we do in academics that doesn't do that. So we go out and we teach them a bunch of rote learning, and then we ask them to be creative and interesting. It's kind of doesn't fit together. I think it's the same thing when you're interviewing with somebody. If you can't engage them, keep their smile, keep them engaged, look them in the eyes, you're going to have a hard time really connecting with them as a human being. If you don't connect with someone as a human being, they don't really want to work with you. They might hire you to go work with somebody else if that's what they're doing. If they're working in HR, they might tick the boxes and say, this is fine, but I hope I never work with this person. But if the real question is, do you want to work with me? I want to know that you're the kind of human being beyond being just a machine that can do the things that I need.
Yeah, I studied in Singapore, and I found many of my classmates were highly intelligent, but then when it came to talking to people, they were a kind of bit odd in talking about it. So I talked about with one of my professors, and I told him, you know what you should do? You should send them to McDonald's to order sushi. Yeah. Just so they get out of their comfort zone, right? That's
well, really... even better, make them work in McDonald's, right? I mean, so many people are busy building their CVs that they never do those kind of basic jobs these days. And I think that's a disaster. People want to go and get that super quanti job at a high frequency trading place. They want to work for a hedge fund, private equity. They're using all their connections to get these supposedly great CV building jobs, but they've never worked behind the counter. They've never had to deal with people and basic selling skills for stuff that you take for granted. Working in a chemist and connecting with people and finding them Sudafed. In McDonald's, keeping a smile on your face when the 40th person abuses you for the fact that it's too slow in delivering their fries, right? These basic things are really important, and I think people think you can jump over them.
Yeah. Now we're jumping a bit ahead of actually what my plan was, but this is a really interesting topic, so I'm really happy about it. Is this something you're looking into if you read a CV, that somebody is not ashamed of having basic work experience in their CV, or that you're looking for in a person to hire, that they're they're hands-on workers?
Well, it's all about truly understanding things as opposed to knowing them. So we talked a bit before about the amount of data you can have, and that you can be covered in data, but not really understand what it means. Equally, I think you can work in a financial context and not really get, so what? I mean, the question I ask of people all the time is, if you're doing something, can you answer the question, so what? If you're writing a piece of marketing material about a product, can you explain, so what? Because it's all very well to say, oh, well, this product in a rising market does this, and in a falling market it does that, and the Sharpe ratio of the performance is above 1, so you should want it, and it has a diversifying influence on your portfolio. So what, right?
That you can read from a spreadsheet.
Yeah. What are you actually trying to achieve? Now, I'm not saying that every conversation needs to devolve to a basic tenet of financial investment. But if you don't understand that, the contextualization of the conversations you're having is not going to lead to people really understanding each other. So I think you need to be able to sit in a dark room and make sense of things before you can go out and just do the basics.
Love the advice. Now, you've said earlier that you've been a while in Silicon Valley. What did you do in Silicon Valley?
After we sold Source to Warburg Pincus, which is a private equity firm, and before Warburg Pincus turned around and sold it to Invesco, I had a gap in between, and I did some consulting both in the finance space and in fintech I looked at potential acquisitions of some startups in Silicon Valley. And I even actually spent a little bit of time at BlackRock to be in their San Francisco office, which is all about the intersection of asset management and the fintech businesses. And my son was also playing football/soccer. He worked for a startup, and he also started his own little tech business, which he then sold to somebody before going to university, which I thought was rather good because I kept bugging him and said, how are you going to save some money for university? He said, I'll do it. And come November, he'd set up his own little tech business, basically providing tech support to all the 50-somethings around Berkeley. And he was doing business and supporting all these people. And then by the end of it, he sold that business to somebody who is long-term staying in Berkeley. I've seen the biotech side of the Bay Area. I have a friend who's in the fintech space, who's ex-Morgan Stanley, had his own fintech business, made a bunch of money, and now invests in little startups and advises them and so on. In going to look at a couple of fintechs, I've done due diligence on them in the Silicon Valley. I've gone to the accelerators around the area and seen how they help people. So they take on, one of the classic things is they have one of these guys has a 4-month accelerator process where they take on 20 companies from around the world. They're not just from the San Francisco area. They give them a certain little bit of money. They take them on, and then whoever wins gets a proper investment, and away they go. And I think it's a great environment where people who are focusing on very different business propositions, but they're all kind of trying to employ the same model, get a little bit of a sense of community. They're not sitting alone in their bedrooms or in a warehouse somewhere. They have the sense of the dynamism. They're being challenged by watching other people succeed or fail with their business models. There's a little bit of money and ownership on the table, so there's a candle, there's something to play for. So I think Silicon Valley is very interesting in what it brings together. We also, of course, have Stanford in Silicon Valley, so you have a bunch of very smart people being educated. And if you look at the Stanford education, it's actually changed very significantly in the last 10 years. People no longer major in the traditional subjects. All the majors are new subjects that people create.
Okay.
So people will take a combination of science and business and so on and create a bespoke major. And then they'll say, this is what I'm going to study.
That's really cool. Do you see a difference between, I don't know how you're familiar with the startup market in Europe or London, but do you see a difference, and what is the difference that makes Silicon Valley so successful?
London's been pretty good, and we've got the infrastructure, and we've got a certain amount of investment and venture capital firms. Berlin is a big place that a lot of people have gone. I think both because it's supportive. Once you get beyond a certain point, you get critical mass, and so you have other people in your space that you can learn from. It's also a young person's city that has a really good social environment. Yeah. It's quite inexpensive, so rent and food is cheap. So if you're in a startup and you're getting paid well below market rates, it's easier to do that in Berlin than an expensive city like London. I think what Silicon Valley has beyond all of these is the sheer momentum and the amount of money and the people who've succeeded who want to turn around and put that back into the industry. So, if you have the people who've built billion-dollar firms and they're still excited because they're young, they're still young even after they become billionaires. They want to start other things. They want to change the world. So you have that combination of intellectual and financial capability. That has a lot of momentum to it. But that doesn't mean that other places can't emulate. There's just a particular perfect storm that's gone on in Silicon Valley for a long time.
And it's a quite mature market, right? They're like at the forefront. I always say in Germany, I hope that we get like several 100 million exits soon over the next year. So those people have the money, they want to reinvest, they want to start Silicon Valley all over again. That's what I'm really excited about.
This is an important thing for Europe, the vision of Europe. So, I talk about Berlin and London, and there are other places further east in Europe where, you have offshoring or onshore offshoring of IT because you have combinations of good university skills, tech backgrounds, less expensive, and nearby from a time zone perspective. Europe's challenge is to stay on message and take advantage of what the unified market does and why we did that versus the United States. I mean, you have a similar number of people in Europe, in fact, slightly more in Europe than you have in the United States as Europe expands. You have a GDP that's smaller than the US, but still growing very rapidly as you take on new countries, less so through the organic growth that we'd like to see through GDP expansion. But you have a movement of people, and I think all of this comes together to change mentalities of whether you have this choice between being defensive and protecting and being aggressive and outgoing. And I think the real thing that we need to harness within the whole European vision, and that is very important in the fintech space, is you have to be positively embracing risk, opportunity, and change. The more that you go to the old Europe, which is defensive, holding on to money, protecting your wealth, and that sort of exercise, that's not going to lead to being at the forefront. And I think if you look at the US and you look at what's happened in Northern California, it is that idea of new wealth, opportunity. You want to invest. You don't need to protect, because the more you invest, the more you will get. And I think that's why that's also happened on the West Coast as opposed to the East Coast, because the East Coast is more like the old Europe. It's a little bit more defensive, a little bit more old money and so on.
Yeah, but I mean, that's generally in Europe the case, right? Nobody in Europe invests as much as in the US, sadly.
Historically. And look, from my industry, the retail investor is less powered to do stuff themselves in Europe. There's a much more of a self-directed retail investor base in the US that people tap into in the ETF space than in Europe, where a lot of money is, there's a concierge who's basically the private bank who controls. And people like that because then they can also blame.
Yeah.
And they can say, oh, if I lost money, it's your fault, right? I think we need to embrace the risk reward of that comes with making your own decisions. And it's a cultural thing, but I think it's there. And I think that Europe and bringing all of these different cultures together and creating a much bigger united GDP is all about creating that opportunity and scale.
I didn't imagine to end up in Silicon Valley, but this is super exciting. But you said you brought up the ETF business. Now you're in the ETF business. I would love to talk a bit about that. What made you found like the second ETF company now? What lessons did you learn from starting your first company that you want to integrate into your new company?
So, I mean, let's look at the two components. So people talk about ETFs, exchange traded funds, and they talk about it being a separate part of the industry. An exchange traded fund is a UCITS fund that you buy through a secondary market transaction, whether it's on exchange or from a broker. Other than that, it's just a traditional fund.
May I jump quickly in? Yeah. What's a UCITS fund?
So UCITS is the broad European regulation for the funds industry, which is basically the same in every country within Europe. It also allows you to create a fund in one country and passport it to other countries. So the main jurisdictions that are used in a lot of the fund industry and specifically in the ETF industry are Ireland and Luxembourg. There are also a reasonable number of funds in France and Germany, but Ireland and Luxembourg have become fund centers.
Why is that so?
Well, it's a combination of factors, but fundamentally they are jurisdictions where they've set up the infrastructure to be able to run funds efficiently with the right resources, the right support services built up, where the different custody and admin businesses have groups of people. They've built up skill centers there. And the local regulation has been supportive of the growth of the funds industry. So if you think about it, if you're going to want a few 100,000 people to be available to support the funds industry in a country, your government needs to take it seriously and it needs to legislate to support the funds industry. For a country where that might be a very small thing, so for example, in Germany, the funds industry will not change GDP in Germany. In Ireland, the funds industry has the ability to be a large section of GDP and therefore be quite important on many levels to the country. it's transformed Dublin. It transformed Dublin up to 2007. We then had the recession, which hurt the Irish economy very badly. But one of the things that everyone will notice is that Ireland bounced back in a relatively short period of time from being downgraded to non-investment grade all the way back up to having a thriving GDP. Their real estate market crashed and has now bounced back in a 10-year period. It's gone through the doldrums and all the way back up. It's not back to where it started, but enormous amounts of building going on in Dublin for commercial, and it's all about the financial services industry and how the Irish can supply services to the whole rest of Europe. And most listeners probably don't think of Ireland as being particularly important. They might think of London as being a financial center. They don't think of Dublin. Dublin, it has the unsexy job of basically being the engine room for the financial services industry, particularly in the asset management space, running funds, implementing, regulating. The Irish Central Bank has a big section of people dedicated to that. So anyway, back to the original question, which was the ETF. So an exchange-traded fund, the most important thing is the F. It's a fund. In Europe, to be a fund, there is some domestic legislation for local funds in countries, but most people set up European funds. European funds are controlled under the UCITS legislation. If you set up a European fund, it's then quite easy to passport that fund from the country in which you create it to the other countries around Europe. Since that passporting process is quite easy and relatively inexpensive, you can now sell that fund to those other jurisdictions. And that's a huge opportunity. If you think again back to the Europe versus US, if you create an SEC registered fund in the US, you are immediately able to sell that fund to all 50 states, which means you can sell it to 250, 300 million people. You've got a GDP of 16 trillion. You want to be able to do the same thing across Europe, because if you can only sell to the Italians and then you have to do a whole nother build process to be able to sell to the Spanish, nobody's going to do that work. It's just the barriers to entry from country to country is too great. And it also doesn't give people scale and leverage when they set up a European fund. The UCITS fund industry has been very good, not only at passporting around Europe, but basically turning UCITS into the standard structure used by everybody outside of the United States. So the South American countries have started using UCITS. A number of African countries will. Hong Kong and Singapore have used either UCITS funds or things very similar, and then allowed them to be sold into their jurisdictions. So when you think about ETFs, it is simply taking a fund, which everyone's had funds for centuries, and creating a slightly different way in which those funds are sold to investors through an exchange-traded process. Of course, the exchange-traded suggests that everybody buys things from exchanges. Actually, they're also sold on a secondary basis. But the basic concept is you don't have to register with the fund company in order to own part of that fund. You can just go and buy a unit like you would buy a share. And that sort of arm's length transaction makes it possible for you to buy thousands of different funds on a very transactional basis, rather than having to go and build a relationship with each fund manager before you're able to buy their funds. That's part of the reason why I think the ETF industry has become so important within the overall fund industry, because it is a very efficient vehicle on the surface for distribution. But I think there's also something under the hood, and that is, even within the context of UCITS, there's quite a wide array of things you can do as a fund manager as far as sharing information about your funds. You can share information through websites, you can have daily NAVs, let people see everything that goes on with your funds, or you can take a much more traditional approach, which is you only have written fact sheets, you need to get them physically, or you can get them through the website, but you get them once a month, you get quarterly updates, and it's much less clear what you own when you buy into the fund. I think the ETF industry has created the concept that an investor should know what's going on. In the passive space, in order to make a good investment, you need to know what's going on, because you're buying something that it doesn't have a human being controlling it, and it has an algorithmic process. So you can fully understand what you're buying, and you need to fully understand what you're buying. In the active space has been a tendency to trust the individual who manages your fund and give over your control to them. And therefore, you've also said, well, I don't need to know what they're doing on a daily basis because that's what they do. They're the professional. I think the opportunity in the passive space is to say, okay, I need to understand how this fund works. I learn how it works and then I know, and 6 months from now, it will still work like that. So I don't need to keep doing it. But it does require me to do a little bit of education and know what I'm buying. But ultimately, if I do that, I then become much more in control of my investment process.
What do you think where the ETF market is going? We all know it's growing very, very rapidly. But do you see any problems with that? On the one hand, how do you make money if you're not, you set the scale, right? If you are not BlackRock, how do you make money off ETFs? Vanguard has zero cost ETFs now. How can you catch up with that as a startup?
Okay, so now you're switching from the investor's perspective. Is this a good vehicle and can I find interesting investments, to the issuer side, and can I make money setting up a business? And if I've got a $6 trillion issuer in BlackRock to compete against, is it possible to be a startup?
Exactly, yeah.
The answer in all industries is it's totally possible to be a startup, even if there are behemoths out there, or behemoths as the English say, because there are always opportunities and value-added propositions and ways to differentiate yourself. The more challenging the asset class is to purchase, the more opportunities there are for value-added solutions. So in the equity space, we've seen rapid growth, commoditization, equity benchmarks are well understood. If you want to buy the S&P 500 in an ETF, you can find at least 20 providers in Europe. It's very hard to distinguish yourself in that. Across the equity space, now everyone's slid from doing what we'd call traditional beta, which is that index exposure, S&P 500, to strategic beta, differentiated beta, smart beta, whatever you want to say is the stuff between traditional beta and active/alpha. There's a whole range of different things you can do that don't involve just, handing money to an individual and letting them come up with a plan. That creates opportunities in the equity space. It's created a slew of new products, but also a standard understanding of the opportunities in differentiated beta. As you leave the equity asset class, there are some asset classes that people have not indexed as aggressively, where indexing is less understood, perhaps less well implemented, and fixed income is a perfect example. It's an asset class that's double the size of the equity asset class. So there's about 50 trillion of assets in the equity asset class, about 100 trillion in fixed income. It's a very diverse asset class. The underlying, what I call them sub-asset classes, so whether it's investment grade credit, high yield, G7 government bonds, emerging market local currency debt, emerging market hard currency, traded loans, money markets, repo. There's so many different sub-asset classes, mortgage, bonds, municipalities, and so on. Each one is meaningfully different from each other. So you cannot make broad generalizations about fixed income. You actually need to look at each sub-asset class and figure out a solution for each. So that's one challenge of fixed income versus equities. There are two more challenges. The second is that even when you look at one of these sub-asset classes, unlike equities that has 70,000 listed equities that an international investor can trade, in fixed income, there are 9 million fixed income securities and counting. So if you pick one of these sub-asset classes, you're still going to have hundreds of thousands of securities. So you can't build an index that tracks hundreds of thousands of securities. You need to have a selection criteria, and there's a lot of debate around the selection criteria. And then the third problem is data. In the equity space, you have fewer securities, they're traded on exchange, and therefore they're traded more frequently, and every time they trade, you have information about it. In the fixed income space, the vast majority of securities are traded OTC. You don't have data collection, and even a relatively well-traded corporate bond may not trade every day. So if you want to build an index around it, it's very hard to say, what's the right pricing? Do I use a closing bid process? There is none. So you put together a heterogeneous asset class, a lot of securities and poor data, and it's not surprising that it's been more challenging to create indices in the fixed income space.
Then how did you do it?
Oh, and sorry, and just to get to your point, you said, well, how do you compete with a BlackRock? The answer is there's room for differentiation when there isn't a standard accepted protocol for something, because then it takes some intellectual approach that adds value to your customers, and it requires you to recognize the types of investment exposure that make sense that are not available in the marketplace. That can be quite hard to do in plain vanilla passive equity. There are many, many more opportunities in fixed income.
Absolutely.
So how did we do it?
Yeah.
So Tabula is a relatively new company. We basically started in 2018. We've been in the process of setting up our own fund umbrella in Ireland, launching our first fund. We're just seeding our second. We're getting approval for 4 more. We hope to be launching another 2 in the first quarter. So the key here first as a passive provider is you need a range of products because you have to create a toolkit. You're not here to tell people how to invest. You're here to ask them the types of exposures that they would like and then show them that you have tools to implement that. From our perspective, we had to look at the fixed income space and select some exposures that we thought were interesting. We started in the credit space because if you think about, for example, European credit, you have an asset class that gives you exposure to European corporates. European corporates fundamentally are doing pretty well. They've been functioning in a low inflation environment. There hasn't been galloping GDP growth, but the good corporates have been cleaning up their balance sheets, getting relatively good returns, paying down their debt loads, and basically building up cash hoards. So most people believe that there's no particular trigger for an increasing default rate in Europe anytime soon. On the flip side, the fixed income markets are affected by the ECB's activity. So when most people think about a bond, they think about the fact that it has a coupon. The coupon is made up of a combination of interest rate exposure and credit exposure. The interest rate exposure is basically driven by what the government does, i.e. what is the base interest rate, and the credit exposure is what does that company pay on top of the government's rate to get people to buy their debt. If you're buying a credit, if you have to put those 2 exposures together, they're quite different questions as to whether you believe that interest rates look attractive in a particular country, or in Europe, you're talking about euro rates, or do you think that you want to buy specific corporates, and is there an implied realized opportunity in defaults? So when we think about what an individual corporate pays in spread above the government rate to borrow, that is the implied default rate for that corporate. It basically says he needs to pay me another 100 basis points a year because that's what I perceive as the risk that he may not pay me. If I bought German government bonds, I think those will definitely pay me. The reality of the European investment grade markets is that for the last 40 years, almost every year, you've gotten paid by corporates in the investment grade space a lot more than you've lost to the corporates that have gone bankrupt. And that implied realized default rate means that you get value from investing in credit. The problem for investors is, how do I get exposure to that specific factor in the credit space without buying a whole bunch of other stuff, which is what the underlying ECB rates are doing, the fact that we've been going through QE, that the cash yields negative amounts, that the interest rate curve has shifted down to unnaturally low levels, that the ECB has been buying corporate investment grade bonds and decreasing their prices, depressing their yields for the last number of years. So what we've been doing is trying to create products that specifically gave you exposure to the spread without exposure to the interest rate environment.
Basically, you factor investing like you would do in equity, do like small cap, mid cap, and you do the same for fixed income.
In fixed income, I think that there's lots of opportunity for factor investing, but the factors are different. So this is the other thing that I highlight to people. Please don't take an equity concept and come into the fixed income markets and try and place it on top. Right? What you need to do is think from within the asset class, what are the factors that are relevant to fixed income? In equities, you've got, standard factors that people think about. You've got momentum, value, low beta, these sorts of things. And those things do exist in fixed income securities. Of course, momentum is important in anything you own. But in fixed income, if you look at a credit portfolio, a bunch of cash corporate bonds, you've got some other factors that are very obvious. You've got your risk to the issuing entity, so the basic issuer credit viability. You've also got structural risk. So whether you buy a senior bond, a subordinated bond, when you buy equity, you're buying into the capital structure of a corporate. You've got credit duration, you've got interest rate duration, you've got volatility. There are a number of different things that go together to create the pricing of a fixed rate bond in the investment grade corporate space. What I'm saying to people is recognize the factor that matters to you based on your own personal or professional views on investing, and try and just get exposure to that factor. And when you think about it from inside the fixed income space, and when I was at Morgan Stanley, as I said, for 18 years, 14 of those I spent in fixed income. So I very much come at this space as an ex-fixed income guy. And I say, I see different factors. And I think that buying pure credit is something that is very important in today's environment.
Do we have a market large enough for buying pure credit on the one side? Because you said you have so many sub-asset classes. Can you scale those particular markets? And the second is, how do you get exactly those factors out?
This is the funny thing. The first thing I'll highlight, and I'm using this word fixed income, and some of them may be going, what is that? The amount of time spent educating readers on the fixed income space versus the equity space is disproportionately in the favor of equities. If people tell you what's happening in the markets, are the markets going up or down, they will basically tell you, are the equity markets going up or down? If they say the markets are selling off, they mean that the S&P 500, the MSCI Europe, Stock 600, the DAX, these are the FTSE 100, they're down X number of points. If you read the FT and also most of the European press, you'll find that there are 7 pages on equities for every 1 page on fixed income. Why? The equity markets are a story market. They're more interesting intellectually. Even if you don't understand the technicalities, you can talk about what's going on at Apple. And you go back to the dinner party experience, you can talk about it at a dinner party. You can talk about it with your mother. If you're buying fixed income, it's a much more technical market. It's not as much about stories because you can trade fixed income based on a technical analysis because there are maturity dates. You know you're getting money back on a certain date. You know you're getting a coupon, and now you can calculate a relationship between people's belief in the strength of a company and where its debt trades, which just doesn't happen in equities. As a result, it's not that interesting to write stories about fixed income, or hasn't been in the past. And as a result, people aren't educated about fixed income. And so you talk to them about fixed income and they look at you blankly and you go bonds, and they go, oh, and you go, government debt, gilts or bunds or oats. And they go, oh, and then they start to understand what you're talking about. So your first challenge is just awareness and education and that natural seeping knowledge that comes into people even without them being aware of it. What's the opportunity in fixed income? Well, it requires a degree of education for the average man, or even for a lot of what we call multi-asset class investors, because a lot of them come at multi-asset class from an equity perspective. However, there are lots of people who spend their whole lives in the fixed income space, and when they look at credit, you would say, oh, well, the liquid market must be fixed rate cash bonds. Well, the reality is the spread market is traded through CDS. Credit default swap. So the basic idea of an insurance contract on whether a company will pay back its debt. So it just says, what do you need to pay me to neutralize my expectation that a company might default? How much spread do you have to pay me to make me break even between the likelihood and not? And the reality is what you end up paying me is significantly more than the actual defaults. And so people trade that market for that value factor. People go, what? What are you talking about? That has to be some sort of, crazy derivative thing that nobody knows about. Actually, the CDS market turns over $80 billion a day in index exposure, and the US fixed rate corporate bond market turns over $20 billion a day. So this is a market that is 4 times the size of the US cash bond market, and yet nobody knows about it. It also trades on much tighter bid offers. It's much more liquid. It's easier to enter on bad days than a lot of the cash bond markets, which can freeze up. So it is a very liquid, very accessible market, but it lacks intellectual understanding from the man on the street. In the financial services space, which is what we're focused on, people who are professionals, they can learn about it, but they have to have a reason to do that. You need to give them a so what. Why would I care about CDS spreads? Well, because you can get specific exposure to credit as a factor, as opposed to just buying a bunch of different things that might give you some yield over time. I think that's relatively compelling because it means you're in control as an investor.
And with CDSs, you only get that credit exposure you want, or are there also other factors involved in CDSs that you buy with them?
So, I mean, let's be clear. The CDS contracts that are available in the marketplace are OTC derivative contracts. And so they're only people who have ISDAs in place can trade CDS. So it's a bit like a professional market that you have to find your way of getting exposure to it.
You have to find your counterparty.
You have to find your counterpart because even reasonable sized institutional investors will not have the documentation and the risk management and the back office in place to run CDS contracts. On the other hand, you do have hundreds of large institutions who trade these things, and that's why we have 80 billion of turnover on a daily basis. So now you just have to find the package which allows you to access that asset. That's why I focused on the ETF wrapper. It's a very robust and well-regulated wrapper for getting access to any different type of exposure that you want to run in a fund structure and deliver to clients. CDS is one example. If you run an on-the-run 5-year CDS index position in iTraxx, wow, that sounds like a lot of verbiage. What am I talking about? iTraxx is the brand that comes from a company called Market. iTraxx is the equivalent of the MSCI Europe of the fixed income investment grade market. It's 125 names. Of those 125 names, 94% of them are in the major equity indices. So you'd recognize all the names. A few, I think 4 of them are in small cap indices as opposed to large cap indices. 125 names, equally weighted, monitored on a continuous basis, changed every 6 months in the roll. This is the benchmark for who are the big guys who issue debt. It's a 5-year contract, so it's like buying we talk about buying 5-year bonds. It is the credit spread for 5 years. It would decay to maturity if you didn't roll your exposure. But what people do is they buy the new 5-year every 6 months, which keeps them at a constant maturity of 5 years. If they do it and they own 3-month government bonds, so they take out the interest rate risk, they don't own a 5-year government bond, they just own a cash substitute, yes, then they have mainly just spread exposure. But as you're starting to hear from what I'm saying, you have to have someone structuring it in a way that delivers you that pure play factor exposure. It's there, it's traded in size, it's highly liquid, but it doesn't mean that you don't need some expertise to package it and deliver it.
And you can't always go play with the big boys directly. If you're like a mid-sized asset or wealth manager, you can't get the access. Is that?
You can't because, as I said, you may not have the time and energy to create the ISDAs and put the collateralization tools in place and run the risk management. You also may not convince the people who do ISDA-based transactions to do the paperwork on their side because, frankly, the sell-side institutions that do ISDAs don't have an infinite amount of resources to put ISDAs in place, and they have a queue and it takes a long time. And also, if you are a manager who wants to do a transaction and split it up and put it into a range of different accounts, you can't do that with an OTC transaction. It's very hard to put that into individual accounts. Whereas if you have a security represented by an ISIN and it's a bunch of different shares, which is what an ETF is, you can break it up down into an individual share and drop that into an account. So it's built to be able to do that.
Okay. Now you explained a bit why investors so far couldn't invest in in CDS, but now why should they? I mean, if CDS, like I'm purposely asking a stupid question here, isn't that what caused the financial crisis? That's like what you heard about.
Well, this is my favorite because for over the last 10 years, and we set up Source in 2008, 2009. So we were setting it up right into the financial crisis. And we thought, boy, this is either a really good idea or a really bad idea. What we discovered was it was a really good idea because we tackled counterparty risk and liquidity and all the issues that came up through the financial crisis. But when we dealt with journalists, they had a perception post the financial crisis that basically anything with a 3-letter acronym was dangerous. And so people would say to me, ETF, that's 3 letters. Ooh, isn't that dangerous? And I'm like, no. MTF, which means a multilateral trading facility, is not dangerous simply because it has 3 letters. CDS did not cause the financial crisis and actually were the most liquid way of trading exposure in the credit markets through the financial crisis. And actually what happened in the financial crisis, for a variety of reasons, was that the cash markets, the cash bond fixed rate markets, dried up, while the derivative markets actually stayed quite liquid. Why? Because to trade cash bonds, you need a certain amount of balance sheet and availability of securities. So let's look at what I said earlier in the podcast. I said there are a very large number of securities in any one particular sub-asset class. If you have a very large number of securities, each of them has a notional value. Someone needs to trade or hold those in their portfolio, in their balance sheet. What happened to the investment banks during the financial crisis? They were all forced to get rid of everything and shrink their balance sheet. So I was in Morgan Stanley at the time, and if I remember the numbers, I think we were levered 42-1 in September 2008 when Morgan Stanley was trading at $75 a share. 2 weeks later, we were trading briefly at $6 a share. Wow. I think we bounced back to 12. By the spring of 2009, so 8 months later, we'd gone from 42-1 to 12-1. What that tells you is we'd kept the same capital structure. We'd maybe made it even slightly more robust, but we'd sold off everything we could sell. And that meant that all of the balance sheet that was being used to own and trade cash bonds had to go. So what basically happened was the cash credit market had been driven by investment banks' balance sheets and liquidity provision, and that went away. And nobody stepped in to take over. Basically, the liquidity in the cash markets became far more challenging. And what people have talked about over the last 10 years is, has the model evolved? Who's stepped into the role of the investment banks? And the answer is no one in particular. The market has muddled through, but it is clearly less liquid. When a market is less liquid, the bid offers are wider. It's harder to find what you're looking for. And actually, strangely, ETFs on cash bonds have stepped into this partially because they're transparent buckets of individual securities. These billion-dollar funds that own individual cash securities, you can have people who are able to trade in the primary markets against the fund, look into the fund and say, aha, there are some securities I want, and they can do a transaction with the fund where they deliver shares in the fund and are delivered the physical securities that are in the fund. And so they created a transparent pool of assets that they know are there, and they can at any one time take cash, buy units, deliver the units, and have delivered back the physical assets in the fund. So actually, strangely, ETFs have become one way of increasing the liquidity in the cash bond markets. But nobody has stepped into the bank's role. So fundamentally, the amount of balance sheet dedicated to cash bond trading is significantly lower than it was in 2007. So when you think about the importance of the derivative market, it's only made the derivative markets more important. In addition to that, we've had the introduction of central clearing of derivatives, which means if you do a transaction with a large investment bank, you may do the transaction with them, but you don't face them over time. That transaction is then moves on to the AAA exchange, for example, ICE. This means that instead of running risk against Goldman Sachs, you end up running risk against ICE, which is it's a AAA counterpart as opposed to a single A or triple B. And so that is a significantly better position for the investor who wants to run a derivative position. Now they can run derivative positions without running counterparty risk. So you're now starting to eliminate any of the reasons for the large traders of the market not to use derivatives as a way of putting on and taking off their exposure. You have tight bid offers, you have high liquidity, and you have a significant reduction of counterparty risk.
I feel like I had a whole university course just in the past hour. Now, looking at the time, I want to be respectful of your time. Do you have any last words you want to give out to the people? Any mistakes that you learned from, any books that you could recommend to read?
I think the key is you're going to make mistakes, so don't be afraid of mistakes. This goes back to what we were talking about at the beginning of the podcast. Anybody who lives their life in fear of making mistakes doesn't live their life. Right? We're going to make mistakes. It's better to embrace the potential. And then when we do, learn from them. You know, it's the old thing about it's fine to make a mistake, but if you make the same mistake the second time, you didn't learn from it the first time. Yeah. Now you've truly failed. Books, I think you got to read things that you find truly interesting, that stimulate you, that make you think from a different perspective. I use an example like the book Sapiens, which is obviously quite old now, and we've moved on to the new book that he brought out. But when I think about that book, it basically asks questions about the things we take for granted. Yeah. And I think that if you do that, anything that someone tells you, this is received wisdom, this is the way things work, I think that should immediately worry you. If someone tells you, when you ask them a question, they can't explain to you why, all they can tell you is, that is the way it is, you've found a problem, right? Yeah. That creates an opportunity for you. And I think the last thing, which I also said towards the beginning, is do something you're passionate about. There's absolutely no point as a human being in this world to be doing things because you're supposed to. We have short lives. We're here for a limited period of time. It's all about having an experience that we can enjoy and share with other people.
Amazing. Now, do you have anything you want to talk to our listeners? Now's the part to do advertising. If you if you want to say anything about yourself, where can people find you? What do you want to be?
I think that the financial world is all about being connected. So, look, I don't want to sell LinkedIn shares, but I do think that LinkedIn has played an important role that I've seen as far as just kind of being a Rolodex and a way to find people. It's very hard to find people's email addresses, and this is a way to send someone a message. So I think LinkedIn is a great way to find people when you just can't think of any other way. I think that people shouldn't be afraid to reach out and try and talk to people. The worst that can happen is they say no. I think people shouldn't be afraid to take risks from that perspective. I also think that people should take the time to have conversations, even if they don't know what the outcome is going to be. So don't just try and talk to some people who you know are going to further your career. Talk to people because they're available, they sound interesting, they might have something. And remember that if you have a conversation that's interesting but it's not relevant, that doesn't matter. Just file it away. You don't have to keep a list. Your brain will remember, and it'll come back at the right time. I mean, that's the one thing that in the whole AI debate, nobody fully understands, and that is this sort of God spark in our heads that we do just create links and come up with connections, and we can't exactly explain how we do it. And that's the most interesting part of being a human. Go out, connect with people, ask them questions, use the tools that are available. Don't be afraid to ask people and have them say, look, I'm just too busy, I can't. Because there are other people who won't. They'll just say, sure, let's have a chat. And remember, your mentors are not necessarily people you work with. At Morgan Stanley, we used to have the mentorship networks. I think it's important to try and mentor people, try and give them someone older, longer in the tooth that they can bounce some stuff off of. But the best mentors are often not in your company, even in your industry. There are people that you happen upon that just have something to offer you that's different than you've been hearing.
Wow, I think we definitely need to do a follow-up at some point. You have so much wisdom to share. I would just love to keep on talking to you for another 2 or 3 hours. But I definitely want to be
I don't think your listeners would feel that way, but
I bet they do. Right, MJ, thank you so much for the conversation. It was a huge insight, and I'm very looking forward to keeping in touch with you.
Excellent. I look forward to it.
Thank you for listening to the Wall Street Lab podcast. For the show notes and much more, visit us at www.thewallstreetlab.com. To see what we're up to before anyone else, subscribe to our newsletter on our website and follow us on Facebook and Twitter.
Disclaimer. Information contained in this podcast constitutes the opinions of individuals and should not be treated as investment, tax, financial, or legal advice. We take no responsibility for the accuracy of any statements made in this podcast. This podcast is for informational and educational purposes only, and it does not contain an offer to sell or buy any sort of financial products, and should not be treated as advertisement for such. Any copying, distribution, or reproduction of this podcast without the prior permission of the creators of the podcast is strictly prohibited.